Cliff Asness has a great line that I'll paraphrase that basically we tend to build portfolios thinking of statistical time. We look at these long-term lines and the diversification properties and go over 30 years. This is great. This is how we want the portfolio to behave statistically. And yeah, sure, I can stick with that. Behavioral time is like dog years though, right? You underperform that core benchmark for 2 or 3 years. To the client, it feels like 20.
Yep.
Right. And there's only, the client can't rent the conviction from you. If the client doesn't have the conviction for that investment, if they don't understand it and they ask you 3 or 4 times in a meeting about it, they're either going to force you to sell it or they're going to fire you as an allocator on their behalf. And so that's what makes these alternatives so very different.
Let's go boom.
Hello, everyone, and welcome to another episode of What's the Alternative, the show where we get down into the nuances of alternatives with the experts in the space. And today we have with us Corey Hoffstein, who is the co-founder and chief investment officer at Newfound Research, a quantitative asset manager offering a suite of separately managed accounts and mutual funds. And they also have some ETFs that they've launched. Corey is responsible for portfolio management, investment research, strategy development, so on and so forth. Corey is brilliant, one of my favorite people in this world of investment management. Have a ton of respect for Corey. Anybody who follows me knows this because I mention him often on podcasts, on X, all over the place. I'm a huge fan of Corey Hoffstein, and I am excited to have you on the show.
Well, thank you so much for having me here. And thank you for that very warm introduction.
Yeah, well, it's true. And I wanted to have you on here today for one reason. At the end of last year, one of the last media appearances I did was on Bloomberg. And they asked me what I thought the biggest trends in asset management would be in 2026. And I said, get really used to hearing the term return stacking because it's everywhere and it's going to be huge in 2026. And for anyone who doesn't know, Corey is one of the brainchilds. He'll tell you that he's not, that it was a colleague of his that kind of termed it, but Corey's the one who brought it to market and made it mainstream. And so I wanted to have you on today because 2 years ago you came on here and we talked return stacking on our other podcast, The Alternative Mason with Brittany Mason. And I want to go into it even deeper because everybody's doing it now. Last year was the year of leveraged ETFs. Everything that came out, it was blockbuster, historic year of the launching of levered products. And in a way, return stacking is a levered product, but not in the sense of like 2 times, 3 times magnified, using leverage in a way that really increases risk. This is a little different. So why don't we start with telling our audience what it is, where the idea came from, and how you have brought it to the mainstream?
Yeah, well, so as you said, I will not take credit for this, both either the name or the concept. I mean, the original concept for this goes back to the 1980s. I think you can trace it back to PIMCO and some of the institutional work they were doing, and it was long called portable alpha. My colleague, Rodrigo Gordillo, is the one who came up with the name return stacking, but I just happen to be the one who maybe talks the most. And so maybe I've gotten credited with being the one, but no credit really goes to me here other than perhaps evangelizing and trying to bring these products to market. I think maybe the best way to tackle this is to talk about what problem this is trying to solve. And that will explain sort of how it works, right? So the problem we're ultimately trying to solve with the concept of return stacking for most people is that they ultimately understand from a theoretical basis that they want diversifiers in their portfolio. But from a practical perspective, getting diversifiers into a portfolio can be very difficult because most people aren't starting with a blank piece of paper. Most people are starting with a portfolio that looks like 60% stocks, 40% bonds. And so to add a diversifying asset class like gold or a strategy like managed futures, or, if you go way out on the spectrum, things like cryptocurrencies, what you first need to do is make room. You have to sell some of your stocks and bonds. So diversification becomes this process of addition through subtraction. And it creates two very real issues. The first issue is statistical. And I know you know this one well from managing portfolios. When you have a stock bond portfolio and you need to add an alternative, you need to make a decision of, well, what am I selling? How much am I selling? What is this going to do to the portfolio? There's a real numerical statistical issue there. And then the second is behavioral. Even though we can look at the history of these alternatives and see that they have delivered on their promise for the most part, they have gone up over time. They've been uncorrelated to stocks and bonds. Many provide very attractive returns during those bear markets for stocks and bonds. They march to the beat of their own drum. And that's why we hired them. But that's often why allocators are fired by their clients, because when stocks are going up, maybe they're not keeping up. And it leads to friction and tough conversations and a real behavioral issue. So that's why what we tend to see when we look at the numbers is that these wonderful diversifying assets don't really end up in client portfolios. And when you look at the category returns, the investment return is quite good, but the investor return is quite bad. There's usually a large performance gap there because people end up trying to market time them. They get in at the wrong times, and it's hard for them to hold it structurally. Return stacking tries to solve that by saying, what if instead of making this an either or decision, it's a yes and decision? So just as a basic example, every return stacked ETF that we offer, when you give us $1, we're going to give you $1 of either core stocks and bonds plus $1 of exposure to some diversifying asset class or strategy. And so what that means is you no longer have to make room in your portfolio. If you were to say, sell some stocks and then buy a fund that gives you stocks plus managed futures, you're getting that stock exposure back and you're getting that diversifier layered on top of the portfolio. And so it totally changes the way in which people can think about adding diversifiers. It's no longer this either or, it's a yes and decision.
Yeah, I think it's Michael Kitces that says that being diversified is always having to say you're sorry. And I love that because it's totally true. And you mentioned managed futures. It's probably the most obvious one because managed futures performance is always an outlier. It's so uncorrelated with traditional equities. And having to explain why you own it, it's like insurance that way. Like, what am I doing? And there's BTOL, which is one of my favorite ETFs. And when it's not doing well, which is it's not rare, it's the same story. Like, why do we own this and not cash? And then I have to remind people, like, do you remember what happened last February? Do you remember how it was up 30% and the market was down 20? Do you remember that? That's why we own it. Cash can't do that for you. Yeah, but we own like now it's down 20%. Like cash would be yeah, but then your timing. We don't own enough for that to be meaningful. You know what I'm saying? So like it's always having to say you're sorry. It's always having to explain the one thing. And to your point, if you're an advisor and you're doing your client reviews and it's the same thing every time that you're having to explain and it's complicated and you're not confident in your own ability to explain why you own it and how it works, then you just want to stop having the conversation.
Cliff Asness has a great line that I'll paraphrase that basically we tend to build portfolios thinking of statistical time. We look at these long-term lines and the diversification properties and go, over 30 years, this is great. This is how we want the portfolio to behave statistically. And yeah, sure, I can stick with that. Behavioral time is like dog years, though, right? You underperform that core benchmark for 2 or 3 years. To the client, it feels like 20.
Yep.
Right. And there's only the client can't rent the conviction from you. If the client doesn't have the conviction for that investment, if they don't understand it and they ask you 3 or 4 times in a meeting about it, they're either going to force you to sell it or they're going to fire you as an allocator on their behalf. And so that's what makes these alternatives so very difficult to stick with. We know, every allocator I talk to knows the principles of diversification and understands the benefits. Yet their portfolios tend to remain woefully under-diversified from what's really, quote unquote, theoretically optimal because it's not behaviorally optimal. And that's what matters at the end of the day, right? It doesn't matter what's theoretically optimal. It matters what the client can stick with. And if the client can't stick with the diversification, it's even worse. You shouldn't put them in that portfolio.
Yeah.
So the question is, can we find a middle ground?
Right. Somebody once said, and I wish I could remember because it was so brilliant. It was like, which is the best portfolio for your client? The one they can stick with. And it's true. But at the same time, these things have real value. You cannot time them. They're impossible to time. You will always get it wrong. It's like buying earthquake insurance after the earthquake. It's like buying flood insurance after the flood. You remember then you need it. It's more expensive at that point. You buy it then, and then nothing happens for 10 years. And you're like, why do I own this? And you sell it right before the next one for the same reason, behavioral. The behavioral stuff is the hardest part of being a financial advisor, as far as I'm concerned. It's why I am not one. It is why I am not one, because during 2008, when I worked at an RIA, I wasn't necessarily an advisor, but I definitely took client calls, and I am not built to be a psychologist. I'm just not built to be a psychologist and have conversations with people who cannot listen to reason and rationality in a time of panic. They just cannot. Try to explain to my dad that he's not losing money if he didn't sell anything over and over and over again is the most frustrating thing ever. And this is what advisors do all day long. It's why I'm not an advisor. I always say they do God's work because I am not built for it.
Yeah, there's real psychological alpha that advisors can deliver for their clients, right? And it's always hard to think about the counterfactual. Well, how would the client perform if they were doing this by themselves? But
Right.
being able to get them towards that maximally optimal portfolio in theory and find that point where it's okay, as close as we can get for where they are behaviorally comfortable, that is, I think, the real value that an advisor can deliver. Figure out where that is for that client, how to get them there. And so for us, to bring it back to what we're talking about today, we think return stacking as a theoretical concept and all the funds that are now coming out that are enabling it for advisors are another tool in the toolkit that advisors can use to get clients towards a portfolio that is more diversified while removing a huge amount of that behavioral friction.
Yeah. So you talked about $1 in your 60/40, $1 in managed futures or gold or Bitcoin or whatever. And in order to do that, it's leverage. I know I had Jeremy Schwartz on pod back in November because we announced the partnership between Bonrian and Wisdom Tree. They are launching their own return stacking SMAs, and Bonrian is running the alts part of it. And so we talked about this. It's leverage. I think he was saying Cliff Asness, again, has been talking about return stacking without knowing it or calling it return stacking for a while. And he talked about like the 1.5 times and the 90/60. And you're talking 1-to-1. So tell us how that's achieved, because I think it's really important, because when people think leverage, they always think, oh my God, leverage is risk. Leverage is awful. You think, flashback, if you were around back then, to the financial crisis, and leverage is the devil. But there's all kinds of different leverage. There's the leverage that is like octane, where you're just using derivatives and you got margin on margin. There's debt, which is inherent leverage, where you're taking $1 and you're borrowing $1, and the cost of the borrow is less than the outcome of what you put that dollar into, and things of that nature. So in your portfolios, and when you think about return stacking, how are you achieving that 2 times or 1.5 times lever?
Yeah. So whenever people are, I think, rightfully wary of leverage, right? If you look at every major financial catastrophe, leverage is usually at the scene of the crime, but it's rarely there alone. It's normally there with over concentration risk and illiquidity. And those things together are just a very dangerous combination, right? But leverage on its own is an amplifier. You can use it to amplify return. And if you're not careful, you can use it to amplify risk, right? You can think of these 2 times, or even people trying to do 3 times or 5 times products, right? If you have a 2 times Apple ETF, you're going to magnify both the return and the risk. And then for people who get in the weeds, you start to think about what that does to compound returns when you're magnifying both, and you end up with a lower expected compound return than I think most people would expect. When you think about using leverage for diversification, though, you can use it to introduce a new return stream, being additive in your returns, but not necessarily multiplicative in your risk. because the thing you're adding is different.
Mhm.
So what's always interesting to me about leverage is people have this aversion to leverage in their investments, but most people incorporate leverage and in fact return stacking to a meaningful degree in their personal lives.
Yes.
A lot of the mass affluent that advisors work with tend to own a home and have a mortgage, and they also have an investment portfolio. That is a form of when you take a look at the holistic household net worth, that's a form of return stacking, right?
Mhm.
Because one of the choices was, will you take all your money and you buy a house and you have a single asset that you have no debt on? Or what you do is you say, well, let me get a mortgage, which is a form of debt, buy this house asset, and then I'm going to use the leftover money to buy a portfolio. Well, when you look at that at a household level, now you have two assets, your house and your investment portfolio, and you got there by using some leverage. But people are comfortable with that because typically houses and investments, they zig and zag at different times. And so there's a degree of comfort to return stacking at the household level. We're advocating for the same thing just within the investment portfolio to introduce other diversifiers. So how do we do this? That was a long-winded way to get back, and I apologize, back to your question, but I did want to set the table with that. There are many, many ways in which this can be done. Within an ETF structure, the easiest way to do it is with capital, that we'll call capital efficient derivatives. These are things like futures contracts or swaps that you can have with a bank that are going to give you $1 of exposure, but you might only have to put up, say, 10 cents of collateral. Because what's going to happen is every day you're going to true up the gain or the loss. And normally, most things you're trading aren't moving by, say, 10%. So if you have $1 of investment, $1 of exposure, and it moves, say, up 1%, your collateral may go up or down 1%. And then you're just managing that collateral. And so you're able to get extra exposure in doing that. And then what you do is, let's say I want $1 of gold. Maybe I put up 10 cents of collateral to buy $1 of gold exposure through gold futures. The other 90 cents of my dollar, I can buy, say, the S&P 500. And now I've got close to $1. You have to do a little bit more engineering to get perfectly to $1, but that's the basics of it. You're typically using some sort of capital efficient derivative to get you a whole bunch of your exposure, which frees up your capital. The same way you used a mortgage to free up your capital after buying your home to invest in your portfolio. So same sort of portable concept there.
Yeah, you say portable. Portable alpha is one of the old terms. It encompasses this, to your point earlier about the concept not being particularly new. It's just become more mainstream and the term's catchier. But you have a suite of products. So you have, to your point, some traditional 60/40 plus managed futures, but you also have return stacking with things like Bitcoin and gold, right? And assets that zig and zag themselves. Can you talk a little bit about the expansion of the opportunity set with this concept of return stacking?
Yeah, so when we wanted to bring this to market, one of the business decisions we made was the clients we had historically worked with were people like yourself who build portfolios,
Mhm.
right? And people who build portfolios typically don't want the asset manager to be prescriptive in this is the total portfolio solution. What you want is building blocks.
Mhm.
And so for us, what we wanted to do is make sure all the building blocks followed a very similar formula, right? You
Mhm.
give us $1, we're going to give you $1 of either stocks or bonds plus $1 of some sort of diversifier. And it makes the math very easy for when you're selling stocks or bonds for what you're buying. So as an example, our RSBT ETF gives you $1 of core bonds plus $1 of trend. RSST gives you $1 of core stocks plus $1 of trend following. RSBA, $1 of bonds plus $1 of merger arb. As you mentioned, we also have one with gold and Bitcoin. RSSX, $1 of S&P 500 plus $1 of a mix of gold and Bitcoin. The opportunity set of doing all this is really quite large. In theory, you can sort of mix and match anything you want. It's a question of should you, right? One, should you from an investment perspective? Two, should you from a commercial viability perspective, right? We are running ultimately a business here and we do want clients to utilize these products. But the other part there from an investment perspective is just because something can be done doesn't mean it's going to be done in a tax efficient manner or in a manner where your expected returns are meaningful after all the implementation costs and slippage, and maybe there are ideas that you could implement that would work fine in most markets but might be catastrophic in certain markets, and you don't want to have that type of risk. And so on paper, in theory, you can really do any combination of any assets within the realm of what's legal within an ETF and a 40 Act vehicle that the SEC will allow. But it's sort of like you get to a point of what's prudent, right? What does make sense to combine, and what is that combination going to look like, and does it solve the problems we're ultimately trying to solve for clients? And just maybe I can end with a point. If I give you a product that's 100% stocks and 100% gold, the return of that product is going to look very different than a product that's 100% bonds plus 100% gold. Both of those products can be used by an allocator in a very similar manner of overlaying gold to the portfolio, but the return of that line item is going to look very different. And that line item return creates an experience for the end investor, right? That goes back to the behavioral frictions we talked about. So one of the things we often think about is what should we combine within an ETF such that hopefully the two things are zigging and zagging, not in tandem. They have similar volatility profiles. It's not going to stand out too much. The overall volatility of the ETF doesn't get too high. That sort of stuff goes back to, it's more craftsman than technical, but it goes back to understanding for the advisor, we're not trying to create more friction than they already have in adopting these solutions.
Yeah, I think that's interesting. You started this conversation by saying, like, where do the dollars come from? That problem doesn't completely go away with this solution. To your point, the bond gold versus stock gold, you're still having to choose which one to pair it with. And when ever I have a conversation about how do I fit alts into a portfolio, the way I do it doesn't have nice, clean numbers. So I always explain it as if I were going to do it and my client gave me $1 million, I would literally segregate them into sleeves. So 800K goes into 60/40. And then 200K goes into alts because then I have 20% alts. But my 60/40 is like 52 point, you know what I'm saying? It's not a clean number. And that makes it hard. The only clean number is the alt side of the portfolio. But that's how I've always approached it. And most advisors want to just know, like, no, I need a clean number. Where do I take it? And on the flip side, there is no clean answer. There's no, this is how much you take from equity. This is how much you take from bonds. That doesn't involve a whole bunch of decimals. And so it gets hard from that perspective. So then they ultimately end up taking 10% off each, which is not equal. Or I always suggest in most cases, taking it from bonds is going to have the better outcome than taking it from stocks, because the risk return profile of alt typically has a better return with a little more risk than bonds. So the risk adjusted return numbers they tend to have similar information ratios. And so that inherently makes more sense to me. But to your point, I'm making a decision based on statistics. And some people don't want to have to justify based on statistics to the end client, because then you're getting into weeds and not, the story is no longer clean. And then when questions come up, it gets worse. So when you think about the products, how are you thinking about those dynamics? Are there statistical things you like to see in that pairing that would make it optimal when you're thinking about it?
Yeah, so there's sort of two ways I can answer that. And by the way, that all the stuff you just enumerated is the classic struggle we see for every allocator we talk to, which is, I think you hit the nail on the head. So many people go with the 60/40 and just go, right, I'm going to just go 50/30/20 because the math is easy, the numbers are easy. It's approximate enough. They don't want to be as precise because at the end of the day, it's all estimation anyway. So if it makes their life easier to do 50/30/20, it's kind of justifiable for them with how shrouded in uncertainty everything is. To get to your question, there's two branches here. One, there's within the product itself, right? And then the second is, how are we thinking about this at the portfolio level, right? So within the products we build themselves, as I mentioned, the things we look for, first and foremost, we want to combine things that we expect to be uncorrelated. And ideally, there's a structural reason they're uncorrelated. So when we take, for example, like probably our flagship fund, again, is RSST. Every dollar you give us, we're going to give you $1 of S&P 500 plus $1 of a managed futures trend program. That managed futures trend program is going to trade global equity indices, global bonds, commodities, including energies and metals, and currencies from around the globe. And it's going to go long and short. And it's going to do that based on trend following signals. While the correlation of that strategy over time can vary to equities, right? If equities are in a very strong bull market, you might see that strategy pick up equities. If they're in a very bearish market, you might see it go short. You get this time varying correlation. You expect there to be, over the long run, about zero correlation, and a structural reason why during a prolonged bear market that strategy wouldn't behave like equities. And so we like that pairing. And then we say, okay, how hot should that trend strategy run? Because that's a decision you can make. It can be a low volatility trend strategy, or it can be a very high volatility trend strategy. And there are some regulatory restrictions here, but we go, well, let's choose a sort of a spiciness level that matches equities or is similar to equities, so that the overall spiciness of the fund is going to be a little higher than both. But what you find is that on any day-to-day, neither trend nor equities is typically driving in the driver's seat more than the other. They're both equally contributing over time, and hopefully that means the equity curve looks smoother over the long run than either individually. And to us, that's like a nice optimal mix in terms of being a product that delivers a unique return source, gives you the beta you want, but also is going to be a line item you can hold. Then the question is, okay, or you have this ETF that for every dollar I invest, I'm going to get $1 of stocks and $1 of trend. How much of that should I put in my portfolio? Right? Going back to the 60-40, do I sell all my 60 and put it all in that fund? And then what am I going to end up with? I'm going to end up with 60 stocks, 40 bonds, and 60 trend. For some people, that's probably fine. For the vast majority of people, that would be a disaster, right? The trend would be so big and drive so much return at the portfolio level, they wouldn't be able to stick with it. What we generally find is when we talk to advisors and help consult in building portfolios, a stack of about 20% is the max people can tolerate. Ideally, that stack is not just one alternative, right? We want to talk about adding trend and a little bit of gold and some merger arbitrage and other diversifying assets and strategies within that stack. And ideally, none of these line items are more than 5%. And I keep coming back to this line item thing, but it's one of these really important points where clients, even though we want them to look at their portfolio holistically, tend to go through quarterly reports line item by line item. And things that stick out are the things that get the questions. And so if you have something in there that's a little weird that keeps sticking out, it's going to end up getting kicked out of the portfolio. If you keep it small enough, though, it can be a little weird and it gets a little bit more leash. And so we tend to say you want to build about a 20% stack. That's big enough to have an impact, but not so big to overwhelm the portfolio. And you want to do it in a couple different alternatives, a couple different strategies, and you probably want each thing to be somewhere around 5 to 10% max as at a line item basis.
So you've basically just made the case for why people should be using the WisdomTree Bonrian Select Alternatives ETF SMA with WisdomTree. So thanks for that, because that's exactly what we do.
You're a friend. Jeremy's a good friend. Jeremy was there at the beginning when all this stuff launched. So if I don't get the business, at least it can go to you guys.
Yeah, so you just made the case for me. Thank you. Because that's exactly what that model is. It's the combination of a bunch of different alternatives. So in this case, we have some managed futures, we have some inflation, like global macro kind of stuff. We have market neutral, long short. We have some Bitcoin in there. We got some fixed income arm in there. So that's exactly what that model and that portfolio is. You can find it on Fidelity and Schwab, folks. Not to push product, but you set me up for that. That said, let's pan out for a second. And I have been talking about how instead of talking about the 60-40, we're going to talk about the 90-60. Can you explain the math behind that and why 90-60 is the return stacking version of 60-40?
Yeah. And I hope when you had Jeremy on, he gave the full history here. But there's a funny history with this 90/60 product, which is ultimately what Wisdom Tree launched,
Hmm.
which is that it was actually born out of a Twitter conversation. So it happened between myself and two anonymous, one of them pseudo anonymous, but I don't want to. If they don't want to dox themselves, I won't dox them. Two anonymous Twitter users, where we were talking about using a 90/60 fund to free up capital. So the 90/60 is one and a half times 60/40. It's 90% equity, 60% bonds. And the idea here is if you were to take, for every dollar, if you were to put 2/3 of your money in a 90/60 fund, you would get 60/40 exposure, right? 2/3 times 90 is 60, 2/3 times 60 is 40. But what you're left with is 33 cents of every dollar with which you can do anything,
Hmm.
right? And if you leave it in cash, you basically get your 60/40 return back. If you invest it in gold, what you end up with is a 60/40/33, where you get a 33% overlay of gold in your portfolio. And ideally, instead of doing it with gold, you would do gold and a mix of other things, right? All the things you mentioned, a diversified set of alternatives. And the idea there was originally just around capital efficiency.
Hmm.
Funny enough, I was in a Barron's roundtable about the future of ETFs in 2017. I said, I think capital efficient ETFs are the future. Jeremy, much smarter than me, said, well, I agree, and I'm going to launch a whole bunch of product on it. Brought that article plus the Twitter conversation to the team at Wisdom Tree, and they launched a product that I don't know why I didn't launch. So kudos to them. Jeremy's a great friend, and it's a great suite of products, and I love what they do. As you mentioned, though, of course, Cliff Asness beats everyone to every idea. Turns out back in like 1992, he wrote a paper about why someone should invest in a 90/60 instead of 100% equity. So nothing in investing is ever really all that original, as it turns out. We're just rediscovering the same things the greats have already done decades before. But that 90/60, I think of as a capital efficiency tool, right?
Hmm.
And you compare it to like what I talked about before, the RSST, where we have the alts built in. The
Hmm.
90/60 is not so much about stacking bonds. People can use that, right? If you're 100% equities, you could buy levered 60/40, and arguably over the long run, it should give you a lift in return and risk. It's just a more diversified portfolio levered up. That goes back to basic portfolio theory concepts.
Hmm.
But the real to me, the real benefit of something like 90/60 ETF, NTSX is the one that's the most popular with Wisdom Tree, is that it allows you to stack whatever you want. It's a choose your own adventure tool, right? So, like you mentioned, you can add all these diversifying alternatives to the portfolio that might be exist in standalone funds. The other thing that fund can be used for is most advisors need to have some cash sitting around. They don't want cash drag. Great. You can add that and make up for the beta that you're missing. Some advisors like to just have some cash around to act opportunistically, or they get capital calls for private funds and they don't want cash drag. Great. A tool like that. We offer one as well. Dollar global equities, dollar bonds, RSSB. To me, it is the Swiss Army knife of return stacking. And the thing we haven't talked about yet that I think is really powerful is we keep talking about diversification, and people always think of diversification as a risk management tool.
Hmm.
To me, return stacking is also opens up the door to a whole new way of trying to outperform the benchmark,
Yep.
right? Because it is, we know the stats inside and out. You go look at the SPIVA reports, it is almost impossible to find alpha in US equities. And this will surprise people. It's also almost impossible to find alpha in US bonds. Everyone thinks bonds is where the alpha is. Go look at the SPIVA report. The numbers are just as bad. Bond managers underperform their benchmark about as often as equity managers. It's just, they're hard to find alpha. And I always say to people, what do you have more conviction in? That you can pick stock and bond managers that can consistently deliver alpha, or that you can just find a set of alternatives that you think is going to beat cash over the
Hmm.
long run? What's better for most people? Like, have a very low cost passive 60/40 with 10% gold stacked on top over the last 20 years, or pay a lot to a bunch of managers who might be tax inefficient and have a coin flip of delivering alpha? Like, I think the former to me is a lot more appealing, especially when you say, well, I don't have to just do it with gold. I can find 5 or 6 alternative assets and strategies that I have conviction in.
Yeah. So as you're talking, when I worked at CLS, which is now called Orion or Brinker, I don't know, it's not CLS anymore, but it's part of Orion. we had this concept of risk budgets. And it's kind of born from the idea of when I worked at Mercer and I worked for the investment management arm, everything was LDI, liability driven investing. And the whole point of LDI is pension funds have a risk budget. And as you get closer to being able to generate enough income in the portfolio from the value of the portfolio with just the income from low risk assets, you become more and more of the low risk assets. But you got to get your portfolio there through growth. And so the whole concept of LDI is to look at the portfolio, figure out what your risk budget is, and then allocate the risk smartly. And so the reasons why institutions use a lot of alts is because they look at a risk budget, and if they use an alt that has a risk adjusted return or an information ratio that's high, they can take that extra money, that dollar and equity, and invest it in something that has a higher probability of excess return. And in essence, that's exactly what you're talking about, is the same idea. And so this concept of return stacking is really just risk budgeting with Octane. And I've always been a believer of risk budgeting. And when I was a CIO at an aggregator, I used the concept that CLS had on portfolios at that RIA. And the problem was that no matter how much we tried to turn the risk up, the alts always made it low. It just did. There was no world in which we could dial the risk up enough to get the risk to the budget that we had, unless we went really on the risk spectrum. But I guess that's the beauty, right? That's the beauty of it. You said you have 2/3 of the portfolio in a traditional, and then you can take whatever you want with the remaining 33 cents. And I would argue that you take 20 cents of that and you put it in alts, and then you take that 13. Maybe you put some in cash, but maybe you take that 13 and you give yourself a risk budget and you throw that into a high risk but high return asset like a Bitcoin. That's the whole argument Matt Hogan makes about Bitcoin. You don't need to put a lot of money in Bitcoin to get a lot of return from Bitcoin. And you can generally end up with a lot of potential for excess return, but not a lot of potential excess risk.
So I think you bring up this really important point that we see happen with allocators all the time, especially with alts. And we talked about the problems of trying to make room. The other problem is a lot of alts are historically low volatility and they're going to be diversifying. And so what happens is when you take that 60-40 and you carve out room and you add lower volatility alts that are uncorrelated to the stocks and bonds, it brings the volatility profile of the entire portfolio down below the target risk level you might want. And maybe you can match the same expected return, but to get an actual uplift in expected return, you do need to apply some leverage, right? That goes back to a lot of the core portfolio ideas from Sharp and CAPM and all that sort of stuff. Like, again, none of this is novel and new. It's just reapplying and giving people the tools to actually do it now. And I think one of the great examples is like merger arbitrage. Merger arbitrage is a strategy that's been around for a really long time. Warren Buffett famously used it with great success in managing his portfolio. It's a strategy where when a company, there's a public announcement that one company's buying another, that second company tends to jump towards the acquisition price, but not all the way. There's a little bit of spread there. And that spread prices in the uncertainty of whether the deal's going to fall apart and the time remaining in getting that deal done. There's a time value and money aspect there. And what you can do is you can step in and buy the deal at that point if you have a high degree of certainty that the deal's going to close and you capture that remaining spread. Historically, merger arb over the last, say, 25 years has delivered anywhere between 200 and 300 basis points over cash, right? So that's a very attractive risk premium. There's a strong argument why it should persist because it is a risk. The deal could fall apart. That shouldn't disappear. This isn't behavioral. They're all very idiosyncratic deals. So how the strategy performs doesn't tend to look like stocks, bonds, or credit. So very attractive. The problem is that excess return floats on cash. And so in a decade like the 2010s, where the return of cash was nearly zero, the return on those types of products was 200, 300 basis points a year.
Mhm.
just not that attractive in total return. They're getting more attractive now that cash rates are higher, right? But the thing I bring up is, well, wouldn't it be really interesting to take merger arb and just stack it on your portfolio, right? Where you don't have to give up the stocks or the bonds and make this either or decision. Like if you want that risk premium as a return driver, man, I'm a lot more confident that I'm going to get a positive excess return out of merger arb over the next 10, 15 years than I am finding an equity manager that can deliver alpha, right? And that's how I think about all of this. Is there's some really interesting lower vol strategies like merger arb that now suddenly can find a place in the portfolio, uh, a lot more, to me, a higher conviction place in the portfolio because you can stack them and you don't have to make room for them.
Yeah, managed for futures is another perfect example of that. Managed futures just inherently is almost perfectly negatively correlated to equity markets. But since equity markets go up 70% of the time, managed futures tend to be the thing on the line item, as you pointed out, the clients like fixate on. And then exactly at the wrong time, you sell it and then it pays for itself and you missed it. To your point, the behavioral aspects of portfolio time targets, but that's another perfect example. And there's a number of them. And I talk about BTAL, the equity market neutral long short beta fund, where they're long low beta and short high beta. And the thing about market neutral, and the thing I always like to tell people is market neutral is much more effective when the relationship between what you're trying to neutralize is persistent, right? Because AGF tried to do the same concept on a number of different factors, and only one that worked was the beta one. Like they tried to do it with value, but valuations are literally rolling the dice. There's no persistence to the relationship there between high PE and low PE. There just isn't. In fact, I would argue that high PE stocks tend to stay at a high PE because they got momentum, and low PE stocks are usually low because there's some sort of issue and there's a value trap. And then you also have the problem with anything that is cyclical tends to have low PE at exactly the time you don't want to own them and high PE at exactly the time you do want to own them. So that relationship is not persistent and not consistent enough to do a market neutral approach. And they tried some other things too. But the market neutral beta, that relationship is persistent, and research low vol as a research concept has been around forever. It's an anomaly. It shouldn't work based on CAPM and all of that. Low vol is the thing that doesn't align with that theory because you should get paid for the risk. But since low vol outperforms more than high vol does, you're not actually getting paid for the risk of that high vol. And that relationship persists, which is why that fund has been able to be successful and predictable. And I always say that's the thing when you're building portfolios that's the most important when you're picking the blocks. You got to
Yeah.
understand the predictability and the likelihood of how the behavior of that block is over time and how that behavior interacts with the behavior of other blocks in the portfolio.
Well, let's stick with BTAL because I think it's a great example of how to put this all together, right?
Mhm.
If you've got a 60/40 and you want to use something like BTAL, which has historically during market drawdowns provided a huge positive return because of that beta asymmetry, right? It
Mhm.
is net negative equity beta.
Right.
But because it's dollar neutral in each leg, over time as the market goes up, it tends to drift a little bit lower. And
Mhm.
my numbers here won't be perfect, but I think over the life of BTAL, the total return is negative 2% annualized,
That is
right?
almost exactly correct. It's like not quite 3%. You're absolutely
Yeah. So,
correct.
so let's call it negative 2%.
Right.
If you have to make room, right, in your portfolio for BTAL, and let's say you just sell in proportion of your 60/40, and your expected return for your 60/40 is, let's just say 5%.
Mhm.
That means you're selling something you've got a positive expected return of 5% for to make room for something with a negative expected return, with an expected return of negative 2%. That's a 7% gap that the diversification benefit has to make up for. That's a huge gap. And so what that means is when I say the diversification benefit has to make up for it, I mean When the market crashes and BTOL spikes, you are perfectly timing the rebalance to be selling BTOL down, buying the 60/40, and getting the benefit of that rebalance.
Mm-hmm.
That's a tough market timing call to have to make every single time to overcome a 7% expected return drag. What if instead you could just overlay BTOL?
Right.
Right? You can use the capital efficient tools that either we offer or Wisdom Tree offers and say, well, I'm going to layer BTOL, some BTOL on my portfolio. Now my expected return is just negative 2%. There's no opportunity cost there,
right,
in the same way. I'm glossing over some financing stuff that's also very important here in terms of how all this works, and we can, maybe later in another episode of In the Weeds, we can get into that.
Yeah.
But it's different, right? And the opportunity cost there is very different. And so the point I'm trying to make is when you overlay this stuff, it's ultimately that opportunity, that you're not having to come up with that opportunity cost the same way.
Yep.
And so it really opens you up to thinking about building portfolios, in my opinion, in a less constraining way. It allows tools like BTOL to find a more natural fit in the portfolio.
Yeah. And you also point out the issue with just looking at, annualized returns on a piece of paper, because in real life, you don't invest $1 and then never touch it for 10 years. There's a
Right.
reasonably good chance that $1 is actually, at the end of the day, like 75 cents of the original dollar, because you've been doing some like profit taking and so on over time. And that's why a fund like BTOL can have a negative expected return of negative 2%. And yet, when I include it in the model that I run, I've never not owned BTOL. I might trim it around the edges. I might have it at 20% at some times and 15 at others, but I've never not owned BTOL. But somehow I've managed to have an expected return for my total portfolio, which is only alts, which is not substantially far off from pure equities, with substantially less risk, even though I have a not small amount of money in a negative expected return product. And everybody challenges me on that. And all I can say is I maintain discipline to the rebalancing effort. And I do make some tactical allocation changes at times. When it really works, I bring it down to 15. And when it hasn't been working for a while, I bring it up to 20. And my portfolio expected return for BTOL is actually positive because of that. And I could replace it with cash, but then when the market tanks, I don't get 30% return on cash, but I might with BTOL. And the other thing about BTOL is it's not even perfectly negatively correlated like managed futures, because BTOL does actually work when equities are going up. I think what was it, 18 or 19? It did just as well as the market because the market was driven by low vol. So I
Yeah.
call it low vol and steroids. But your point is the point that this entire episode is really about, which is these products have real value, but the decision to invest in them, how and how much, is inherently complicated. And most investors don't have the desire to have this conversation and be thinking about that. It's too much bandwidth to put into something. And then the advisor also does not want to. You and I are complete dorks, and we can talk about this for hours. But I assure you, a lot of people would be put to sleep by this conversation. And so you don't want to have it all the time. And I think that really brings, in essence, the key message to this entire discussion, which is that this concept of return stacking helps simplify the decisions as it pertains to these really difficult statistical debates that you have to have if you don't do it. So before I let you go, what do you think, since we started the episode off with this, are going to be the key trends in asset management in 2026?
Well, I will start by, you know,
You can talk your book.
yeah, I'll talk my book. I mean, look, we are. I pretty much dropped every other line of business a couple of years ago to launch the return stacked ETF suite. We've gone from 0 funds to 7 funds, 0 in assets to about 1.2 billion today. Morningstar has created a whole new category for this suite called multi-asset overlay. We launched the first 100 equity trend ETF. At the end of Q1, I think there's going to be 10 similar funds in the US, Canada, and Europe. I don't see this going away. Portable alpha at large has seen a huge resurgence and renaissance in the institutional space. And I think what we're seeing is a parallel growth in the wealth space, that these tools are making their way into the wealth advisory book. And I think we're just getting started. The same way buffered products went from non-existent to a $100 billion category, I expect return stacking concept products to do the same over the next 5 to 10 years. So I think that's huge. I think the other trends we're going to see, I mean, again, I don't like to prognosticate macro, but I think we are seeing a lot more interest in, especially this, we're talking in January here with silver and gold and everything going on there. A lot of people rethinking their books going, okay, do we have a de-dollarization trade? Do we actually have to think about international diversification? Do we have to think about diversification to hard assets? 2022 was sort of the scare. I think people then went, oh, we're fine. I think last year, is I at least have started to see in the allocators that I consult with a bit of a sea change back to what I saw in my career in 2007, right? Whereas like every portfolio I looked at in 2007 had gold in it. And then it went a decade where I never saw gold again. Now I'm seeing gold. And I think we will continue to see, I hate to say price sets narrative, but as long as those assets are performing and you're seeing continued geopolitical volatility, I think you will continue to see people start to increasingly diversify their portfolios away from core US stocks and bonds to help manage some of that risk.
Yep. Makes sense. It totally makes sense. And the buffer analogy, I think, is a good one. I felt like last year was the year of leverage and crypto related buffer products. They were freaking everywhere. I have opinions on buffer, and I want to have a guest on here someday that will debate me on it because I think it'd be really interesting. And I'm curious if they could change my mind on buffers because I love when people can get me to change my mind. It's yet to happen, but I think you're totally
my guess is we're on the same side of the fence on buffers.
Yeah, probably.
So maybe I'll listen in and get my mind changed as well.
Yeah, I think it's exactly correct. And I think the reason we're seeing the rise in alternatives as a whole is A, accessibility is completely opened up and now is a conversation that can be had. I think the ultimate challenge that advisors and investors face in the alt space, whether it be ETFs, mutual funds, interval funds, or private placements, as the custodians continue to make it hard to trade them. If you try to, I don't know how it is with your ETFs, but a lot of alt ETFs, if you try to trade them at the custodial level, they make you change your risk tolerance settings.
Yes.
Which is bonkers to me. And then a lot of people, once that happens, they freak out and just don't even proceed. And then you have what's happening at Fidelity right now, where they just decide, we're just not going to take in any new assets to any long short SMAs anymore, which is fun. So alts as a whole is an uphill battle, but to your point, continues to make it. Despite all those hurdles, you've been able to raise $1 billion because the demand is there. And ultimately, the demand wins, like anything else. So yeah. I completely agree with you on your assessment there. I think you are totally correct. And I'm glad that I got to have you on the pod because this is a conversation that I think people will find interesting, especially considering the growth of these products. And the more of them that come out, the more questions that there are. And hopefully people find this podcast and use it as a way to get a master class on return stacking with one of the best in the business. So thank you for being with me. I really appreciate your time.
Absolute pleasure as always. Absolute pleasure. Thank you, Shana.
And thank you everyone for watching. As always, remember to like and subscribe so that you never miss an episode. And if you have a topic that you would like us to take on another episode of What's the Alternative, feel free to leave it in the comments. I am Shana Orczyk Sissel, the founder and CEO of Boundary and Capital Management, and thank you for joining us for this episode of What's the Alternative? The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Boundary Capital Management's platform. As such, Boundary may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Boundary and Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Boundary and Capital trademarks mentioned are owned by Boundary and Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.